I always said, if you can't get any real buying, what you do is you create a short position and it'll hold the market up until the real buying shows up. Okay. That's stock promotion 101, just so you know. Okay. Now, the same effect has happened in this market, not because they intended this, but what happened is when this market gapped at the end of last month, people shorted it. It gapped again. They added to their short position and they kept adding to their short position. And then when the price went lower, instead of covering the damn thing, they added to their position. And boom, and add, and boom, right? That's just simple market mechanics, right? Anyone who's ever done a short squeeze, you know, will tell you that that's exactly how a short squeeze is done. You gap, you trap the people, and you gap again. And this is just done by shutting off supply. Now, supply in this market didn't shut off on purpose. Supply is shut off because the other time frames aren't selling, right? Yeah, and Miguel is right. There were a lot of traders buying a lot yesterday. Remember, I showed you the time in sales that had over 200 lot prints. They were plentiful, right? Also, market makers were absorbing inventory. Now, what does that mean? When market makers absorb inventory, they have a big buy order. They're not just going to stand there and buy 20,000 contracts at one tick. They have a buyer. You know, the two ways to get the market up are to put lots of buying into it. The other way is to just keep getting people short. Because what happens when you develop a short position in a stock, in a commodity, in anything, in any market, when you have a short position, what that does is that provides what we call, it sounds kind of weird, but we call it a natural bid, or we call it an endless bid. Because what happens is the shorts, by bidding to cover their short, end up doing the job of retail buyers or real buyers, right? It's a beautiful manipulative technique. Like when I take a company public, hey, Big G, good morning. How was your weekend? When I take a company public, and if the ghouls who take it public will actually allow me to run the deal my way, the first thing I will do is I'll build a short into the company, like into the stock, right? This means we don't have to work as hard to hold it up. So if you take it to $4 and you have lots of people short at 3, right? They'll hold it up for you. You don't have to work as hard. So if your boiler room doesn't bring in a lot of buying that day, it's not the worst thing in the world because you're the only real seller, right? See, so now in the market, what has happened is, in effect, the other time frame, the people who own massive, massive positions, who aren't willing to sell them for 20 years, have become like the stock promoter who has all the stock in their desk drawer. So there's no supply. Now what we've done is we've created what they've done in this market. We had this balance, and everybody was thinking this was a breakout and a fail, and that we were going to break out of this balance. We did. Here's the balance area. We broke out of it. We should have come back in. I'm going to do a little John Madden chalk talk here. Okay. This is our balance area that we had. We broke above, came back in, right? People got short this move thinking that we would come back down to here, right? But then this happened, the gap. So what happens is now all of these people that were shorting this because they were looking for this are stuck. What do we, hey, Shah, what's going on? Good morning. Oh, I'm going to get to Shah. Yes. So in effect, it's like BlackRock's running a boiler room, right? Not intentionally because they all went to Harvard, but here's the thing. okay, the effect is still the same as if it were done intentionally. It's just mechanics, right? So now you've got all these people short here, and then what do? What they do is they gap it again, right? Now everybody, you guys call this a fantasy island reversal, something like that, Mr. Rourke and Tattoo. Anyway, all you candle wax guys are hammering here, and then what happens is they keep dipping the market down, and people follow price, get trapped short. Ooh, there's no supply, right back up, right? Now, this is something that I used to do on purpose. So I know the mechanics of it. That's the only reason I figured this out, because I used to trade for ghouls, right? And we would actually plan this, right? But what has happened because of people's psychology of it has to go down, I must short, right? And not realizing that there's no supply, the net effect is the same as somebody would have done it, you know, in a manipulative fashion, right? We don't want to be known as tinfoil hat people, but that's what happens when markets get short positions built in them. Once again, everyone was piling into this area, but there's no supply. This is why I love profile. You can see the position of the wholesale. Now, people who are new to this are listening to me and I sound like I'm talking about alien cryptography or something. Just bear with me. I'm going to do a class tomorrow night and we'll get some stuff down. Yes, exactly, right? And it's thin. They swept the book there, LC. This is what they did. They bought everything here. There's 265,000 contracts in this little chunk of time here. Okay. I don't know how much would have been client orders, but I'd say maybe 100 of this, I'd say, went into Citadel, Virtue, and all of those guys' inventory, right? And some prop ghouls, like our friendly neighborhood prop trader, RX, right? His more ghoulish counterparts would have taken down, 20, 30,000 contracts. And then what they do is they open it up and you can see they couldn't, every time they got close to that position, they just bought it all back up because they're already long here. So they're just adding to their position. They know that they've got and they just put a big bid here and you just sell to everybody. Once you're done selling a good chunk and you cash up, buddy, up again, right? I took this little short here. I took a short at '02 and I covered in this F drop and I went to sleep. And it's a good thing I did too, because I was looking for it to come back down here, but it didn't. Then once again with the one time framing, and then this I period runs all of these stops here, because the stops are B, C, D, E high. So that runs that stop. This is the mechanics of what's going on that creates the pretty chart. And the other time frame, the ghouls at night just keep pushing this up. Now they've got a big, nice position here, and they're the only seller, and they're just selling it up. Here we do what we call an inventory adjustment. This is like a trend day, right? Pretend this part is like a trend day in the ES. So you're one time framing up, then you stop one time. What did they stop one time framing? No, they didn't, right? So you stop with the upward movement to correct inventory, but yet N period never takes out M and O never takes out N, so you're still one time framing, right? And you continue to do so until here. So this is distribution of all of this. This is how this is how these guys make a nice, and gals make a nice living, right? Because if you put together 50,000 contracts in this area, another 10 or so, and you're selling 50 all the way up, that's a nice evening. It's a nice way to start a week, right? So now that we know at nighttime, right, because the longer time frame's not around to sell, right? So we know that there's no supply at night, so we always do the go with trades, right? And now the other time frame's sitting in the chair going, Okay. And you'll see this is these areas where it's thin in volume. This is where the prop traders swept the book, which means you buy a position, then you just take out all the offers and make everybody chase price, sell a little bit, take out all the offers, make everybody chase price, sell a little bit. And every time you do that, you bid, right? You 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 buy a big position, you move your bids up, you sweep the offers, you put a big bid here and sell. Then you do it again. That's how you make a market, right? If you look at this profile, well, I don't know, Ian. I can't say they're going to take it down to 3,400, but there should be some sort of test of that level, and there should be some sort of correction to inventory, right? Now, I could be completely wrong. We could open up on 30-to-1 positive breath, and we could gap and go, right? Another popular thing. Now, bear with me. You know, you're not far off, Ian. Check this out. Check this out. Okay. Something that they have been doing is they get really long overnight, and then they take it down like they're going to do a gap fill, and they stop just about here or just about here, reverse and go back up, right? The thing is, okay, what the nice thing about when you gap a market, right? You can sell very gently, right? So even if you have product from here, from Friday, right? When you gap a market, you can just gently, gently sell all the way down. But you don't sell all the way down that you kill the buying, right? You just sell because what happens is when you gap a market, people will put good till canceled and then limit orders here, 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 here. So you want to, this is what we call feeding the ducks, right? You gap a market so you can distribute product, right? They come for it, and then what you've done here is you've created demand. Now, the smart thing to do would be to introduce a little supply, right? And cash up a little bit, right? And that's exactly what market makers do, and that's exactly what size prop traders do, right? You create your own liquidity. So if you had to sell 1 million shares of something and the stock was 30 cents, you can't sell it all there. So you got to take the stock from 30 cents to $1 and then sell the 1 million shares down, right? And then maybe you'll get 50 or 60 cents for that 1 million shares, you see, or even 40, right? But you have to create your liquidity. And that's what goes on every day in this market is we're creating liquidity, right? That's the whole thing, you create the liquidity to get out of. Now, we don't have true liquidity because as you can see, Apple's up 3% on 1 million shares of buying in the pre-market, right? So you're moving 4.3 billion shares of stock, 3% on 1 million shares of buying. This is what we call a thin market, right? Apple's $515 bid. Or no, that was the high. It's 513. But it actually got over my 514.98. And like I said, when I drew these levels, I was laughing. Every week I draw these levels out and I laugh, and then 2 weeks later it hits them. So I don't know. Tesla, uh, we had somebody on the podcast back here who thought about shorting it. I told him not to because this is a clear. When you see a pattern like this, we'll take a look at this on in the equities room too. When you see a pattern like this in a stock, you don't want to short that. You want to be very careful to take a look at this day and see what those bottoms look like. This means right here, this profile structure, that means the selling is shut off. And you don't want to short a profile that looks like that. Because what this is this is an intentional fade, right? You're in a balance, you fade the stock to clean out all of these suckers, and then zip right to the back. What you've done by fading this is you've taken out a lot of this weak supply. You don't want people, you want buyers to hold it till 3,000. You don't want them to be flipping in your face here. So what you do is you take them out by scaring them, and then you move a market up. That's how markets move, right? And you can see with Apple, there is no selling because you have these crazy, crazy P formations, right? There's a massive short in this stock as well, which is very common when a stock splits. I mean, this is Tesla, sorry. This is very common when a stock splits. Apple has some P formations too. Yeah. You know, you really, really, geez, this is even worse. Yeah, see right here? You know, as Disco Nun would say, no bueno. Hey, enlighten me, good morning, right? So you got to be very, very careful. You look at these profile shapes, and a lot of them will really, really tell you, um, you know, what the order flow is in the market and what the intentions are of the people who have all the money in the stock. And that's really what's the most important thing. Price action in markets is the only thing that's valid because it's actually what's going on, right? People could speculate on this could happen, that could happen, but the tape never lies, ever, because these are transactions, right? This isn't some order book that you can spoof or moof or doof or smurf or I don't know what the hell you guys call it, but put in fake bids and things like that. These are actual transactions that have occurred. You know, Enlighten Me bought something, I sold it to him, that price was recorded, that transaction has happened, right? That cannot be faked. So those transactions leave footprints, right? They leave structures, right? And by these structures, we can tell. Good morning, Chris. Welcome to the room. Good to have you. Yeah, so what we do is we look at these structures. They help us determine things like um, acceptance, right? You'll hear me say price is being accepted, right? That means price over time is trading at a level. And that's basically the blue stuff right here. These are what we call value areas. And that's where 70% of the volume has traded. Or you can look at it as 70% of the time. I think I've got this one set to volume, right? A nice thing too is you can look at an area and call this a balance area. And then when we break out a balance, what we do is we double it to find the target. You know, and last night I kept saying if we get acceptance over 33.96, short sellers be careful. And here we are at 34.20, right? So you can take a look at these charts. We broke out of balance a couple of times, couldn't get down to the bottom target. So of course we break back up to the top. You know, Friday, this sort of weird manipulation at the end of the day uh, just showed us that really there is no selling in the market. And I had this 96 level marked off for a while. Would we get up to 96 and a quarter on Friday? And, you know, not much you can see. There's very, very little time spent under 96 in the overnight. So the overnight distribution, right? We look at these and we call these distributions, right? And what these are for new people in the room. So, and then these things are called single prints, where you have just one little line. Now this is like single prints have to happen in the middle of a profile, right? We have buying tails and selling tails at the top and the bottom. But when they occur in the middle of profiles like this, we call them single prints. And what they are is they're kind of like a gap in the middle of the trading session. So there was a gap here, here, and here, right? So we have 1, 2, 3 sets of single prints, and we have 1, 2, 3, 4 distributions. And why is that at all relevant? Because if this was an RTH, like if this was regular trading hours, we could use this the next day to see, oh, is price staying in this distribution, or does it go down here, right? And once we see price being accepted, then we know instead of shorting when it gets down here, we want to buy because it's going to return back up there, right? Very weird way of looking at the market, but it's pretty darn effective. So these things are called market internals. Yeah, we see them quite a bit, AJ Rob, lately. They just run out of steam, right? I would say definitely. Now, here's the cool part about market profile, okay? You see this big chunk of volume right here? This is the volume and this is the time, right? So we've spent about 3 hours here, right? 6 TPOs is 6 half-hour periods. We spent 3 hours in this area. Here's the volume. So when the market opened, what we're going to look for is this scenario. We're going to look to see how much of this is trapped. Because if we don't get this movement up and over the overnight high right away, this is going to be trapped longs. And trapped longs equal supply, and the market will come down and take out these trapped longs. So we're going to use these levels to see how much of this supply comes out. If we only get down to here, then we'll know that there's really not that much that's trapped, right? This is how market profile can really help, because it's just supply and demand, right? Trading's just about supply, really. If there is supply, we go short. Once the supply is extinguished, is finished, dries up, we go long. That's it, right? So if there is no supply, there's no reason for us to be shorting, right? And in these markets, the only supply that's lately been coming is from trapped longs, right? We don't have companies like BlackRock selling Apple into this market right now, right? Because they have 300 million shares of it, right? So they don't really have a market to sell it into. There's not enough liquidity, right? So what happens is the only type of selling that we get, unless it was in March, right? But for 2 years, the only selling we've had are trapped longs, and they get taken out and the market keeps going higher. So we use supply to see when they're trapped and how much of it. And we can just use this kind of like a gauge to see how much of that comes out. Buy-ins are sort of a violent way of covering, okay? And I'll go through that buying process. It's It's a good question. It's probably fitting that we open the discussion tonight on that process. If you'll notice, and I've been going on about this for the whole month now, and actually back around this 33.28 area, I said, you know what, if the market's going to get up to the 3400s, or it's going to continue this move higher, two things are going to one of two things will happen. One is that there'll be an inordinate amount of buying, a huge amount of buying, and we would have seen that reflected in our market breadth. You know, it would have been 4-to-1, 5-to-1, 10-to-1, you know, a lot of buy side volume, or we would have to build a short position in the market to get it higher. And lo and behold, we built a short position. So people got short in this area, into this gap. They added here, and they continued adding into this balance, because a lot of people will think that this balance breakout will lead lower. Then, of course, we had a gap over 3,400. We didn't actually trade 3,400. We gapped over the all-time high. We actually never traded at the all-time high. So what happened was, when we gapped into this area here, larger size traders and some fund managers and what we call other time frame players started accumulating positions or initiating positions above 3,400. As ridiculous as that seems, that's what happened, and that's what these profiles show. They show longer time frame accumulation because they're a B profile in reverse. So what happens is they accumulate, and then yesterday, right? Now, either Tesla splits tomorrow or Monday. I think it's Monday, right? And I think Apple does as well, right? On the last day of the month. So what happened 2 days before settlement of the last day of the month? The buy-in process started. Okay, now are you guys familiar with buy-ins at all? Have you ever heard of such a thing?
Not me.
Okay, I'm just asking the group. Yes, that good, and that you're supposed to be confused, FG. That's good. That's a great question, and I'm going to talk about that at length. Okay, so I think Tesla. I saw the bat on Twitter just now talking about Tesla. Tony Batista from Tasty Trade, and I think it's Monday. So what happens is, okay, say you're a fund manager and you're short Tesla, right? And you're one of these knuckleheads who's been shorting this whole move, right? What happens is those people don't trade like you and me, okay? They get extended credit. They talk their prime broker into doing things because they're feeding the commissions. Their prime brokers will let the rules go kind of lax, right? A prime broker is something I should talk about as well, but it's kind of a fancy brokerage account. It's kind of like a VIP brokerage account, right? You like once you get a prime brokerage account, a whole new world opens up to you, right? It's like you get first class tickets everywhere, right? You get stock borrows that other people don't get. You get credit. They'll also go and raise money for you. So if you have a little fund and you have a couple of $100 million, they'll go raise another 200-300 million for you and give you leverage, right? So you could have maybe 400 million under management. You leverage that up 4 times, you got $1 billion too. So you think you're a hot shot, you're out there and you're shorting these things like Tesla because you were raised somewhere that you don't know anything about supply and demand. So they're nailing this thing. And what happens is, so say for every share of Tesla now, on Monday, you are going to be short. It's 5, right? Apple is 4-to-1, Tesla is 5-to-1, right? So you're short 100,000 shares of Tesla, right? Now you're short 500. So what these clearing firms do is they buy you in before the split is realized. Okay, which means So, for example, Chris, you're my client. I'm at Goldman Sachs Prime Brokerage, right? Uh, and I go, Chris, brother, I know you give me 2 million in commissions every year. Look, man, we gotta you gotta cover this position. It's gonna crack, JJ. Don't worry, it's gonna crack. Just give me another day, right? I'll go, oh man, my boss is all over my ass, right? We gotta get delivery, right? Because it's coming. So what happens is the next day, they're like, the boss takes it out of my hands and says, okay, you know what? Go buy this guy in. Okay, you're not willing to do it. They just give the thing to the trader. And what happens is the trader starts executing the buy-in. Now, buy-ins are a horrible thing, and it would explain the structure, and it will also explain the internals of the market 2 days ago. And you're not going to hear this anywhere else in any other trading room because these are the dirty secrets of the industry. If you are short in this area, right, or say you're going to get bought in this area, remember these markets have no supply. The buy-in process starts, okay? This is very, very interesting. The buy-in process starts, the prime brokers have loose lips. So Chris is my client, he's getting bought in, right? Raz is sitting next to me and he's telling his clients, hey, clients getting bought in on Tesla. So Raz's clients start buying, thereby lifting out the offers. Our executing trader is going to buy in and he is not getting any supply. So this starts to snowball, right? And what happens is, say for example, it's just a stock, right? And your stock's $5 offered 5.25, right? And you're short at 3, right? When you get bought in, you could get bought in at 7, 8, 9, 10, $15 a share. You can get bought in over where the ask is. Now, I know that doesn't make sense to you guys, but this is where the industry is. Like when there is blood in the water, the sharks will come and they will tear the flesh from your bones, right? If you are getting bought in, right, there are people that know that you are going to get bought in, and this is their opportunity to put you 6 feet in the ground. And so that process starts and it's a cascading effect. Remember in markets, when someone is desperate, if they're desperate to buy, what is the rule? You take advantage of them, right? If in a market, if someone is desperate to sell, what is the rule? You take advantage of them, right? So what happens is you start getting bought in above the offer, above the offer, above the offer. Now this doesn't show up as real buying, right? Because what's going on is certain instruments are getting bought in, and it's not the New York Stock Exchange doesn't have a whole bunch of buying coming into it. It's very specific. It's like one order and then another order, and it happens. It's really quite. It's a violent process, right? So that explains the structure. Hey, Erman, right? That explains why we one time framed up, and we didn't stop. I'm just going to switch these to letters. This is just a nice clear chart. A, B, C, D, E, F. G was supposed to break the low of F. It did not. H could not break the low of G. I could not break the low of G. Hey, Ray.
Yeah.
There you are. So we one time framed up until J period. This is unheard of, right? The reason was people were getting bought in on Tesla and Apple. Also, traders in the ES were starting to panic cover, right? This leads to like a snowball effect, right? And as soon as people know that there's a buy-in, they're getting long, right? And you have momentum traders come in into the ES market, not particularly into the broad base of S&P stocks. That's why the breadth was horrible. The ticks, whatever, right? The advanced decline line was negative all day, right? So the buy-in process is a very, very violent way of forcing somebody to buy something because you're buying something against their will and you're taking the control out of their hands so they have no control on how much they're going to pay for something, right? So what I would do in a stock trade, how I would create a short squeeze, I'd open a stock at $2, take it up to 5, bring it down to 3, right? Then take it back to 6, and that creates your short position. Now you've got a short built into the stock. And does that sound familiar? Yeah, we have a short built into the market right here, right? In this Mr. Rourke Island, Fantasy Island reversal of whatever you guys call it, right? So that creates that short position. Now I've got basically that stock on a leash. Because what I've done, I'm the one who controls the supply. In this market, it's not like someone's controlling the supply, but in effect it is because all of the supply is held by institutions who have no intention of selling them, selling these companies. So that creates, and I've been saying this for a year now, there is a shortage of supply in the market and it causes unnaturally dangerous short situations in markets and we witnessed the net effect of it yesterday. I'm surprised we haven't seen this more often, right? This was a very violent buy-in day. Most people don't even know what buy-ins are because they've never been bought in, right? Most of you guys, when you short something, you borrow, you short, you cover, right? And your process is done. I don't know if any of you guys have maintained a short, right? Yeah, I'm going to do that, Steve. I'm just finishing this up. This is kind of a complicated thing and it's kind of important because it explains everything that I haven't forgotten them, right? It explains the market action that's been happening over the last week and very much so yesterday because a lot of people had a lot of trouble yesterday. So that's the buy-in process. I'll get back to it because we'll keep going over it and over it again. All right. How do I use VWAP as a market maker? What you do is you work orders according to VWAP. So Bean Hacker, if I had to buy 1,000,000 shares of Microsoft and you gave me an order to buy 1,000,000 shares of Microsoft, I would work that order so I could buy it below VWAP. VWAP is an institutional standard and you try and get your clients fills that are better than VWAP. So they can, because that way they can call you, right? The next day. You want their business, so all your trades are done regarding VWAP, right? Also, when you finance a company, you do it at a discount to their 14-day VWAP. So I'll get back into that later. I just wanted to cover that, but in the buy-in process and what's going on in this market, yes, they do get margin calls, especially at month end, Raz. Month end, see, that's why they split the stock at month end, right? You give people the shares one day before the end of the month, and that forces the buy-in process. Now, I'm sure the short position in Apple wasn't as big as the short position in Tesla, but, now buy-ins, I'll tell you how I do a buy-in, right? So Ray's my client, right? And I've established a short position in his stock at $3. He has all the stock. It's sitting in his desk drawer, right? and he slowly puts a little bit into the depository trust, just enough for nobody to raise any red flags, right? Now what we've done is we've got everybody short from $3 to $6, right? I take the stock to 10, right? Now, when I take the stock to 10, I can do it in a leisurely manner because I don't need to buy a lot, because every time I move it up, the shorts go to cover and I put a bid over the short. So say Bean is short at $5 and I take it up to 6. He tries to cover at 6. I go bid 605. Now it's basically like putting him under the water and throwing ice over top of him. He can't breathe, right? So that's what happens in these markets with the buy-in concept. Now the buy-in, say now I really want to put the boots to him, right? I know he's short at 3. I got the stock at 6, right? So we'll call his broker and go, hey, Bean selling stock, can he guarantee delivery? Like, can he actually, can he deliver the stock that he's selling? Oh, yeah, right? So as soon as I find that out, I'm like, okay, we're going to buy you in, right? So you're short 100,000 shares, maybe at an average of $4 or $5. Well, now it's $8 offered, right? Go buy it back. Bean goes to buy it at $8. I sell him 100 shares and move the offer to 10, right? Then I can have his clearing firm buy in at any price I ask. Then I can move the offer to 15, 20, 30 and buy you in at $30 and you're short at 6. Guess what? You're done. I would purposely build a short position in the company if the company insiders were smart enough to allow me to do it. This does not happen at every month. You're right, right? But you have to use the profile, and you have to have a little bit of understanding of how markets work, right? Because there is a mechanics to the market that creates the chart, right? And chart-based traders are, you know, um, are, they'll just trade their chart, and that's fine. But sometimes things happen like yesterday and today that kind of don't make any sense, right? And when that happens, it's pure mechanics. It has nothing to do with companies' valuations. It has nothing to do with what intelligent people say. It has nothing to do with indicators or anything. It's pure mechanics, right? And what has happened in this crazy market is that these funds, like BlackRock and Vanguard and Fidelity, have bought so much of these companies that they've effectively locked up their floats, right? It's okay to short the ES. There's going to be a time when there is, but the ES has had a mechanical short put into it by accident for a month now. And now the end of the month has come and we have to pay the piper. The only problem is, when will this be stable? I don't know, TP. I was waiting. See, yesterday, I honestly thought that some of this would come back. And usually what happens is, you know how Dalton says short selling weakens a market? You keep hearing that. Short selling weakens a market. I'm sure you guys have heard it in his videos, right? Well, what that means is when a market's going up and the only buyer is a short seller who's covering, once they're finished covering, the market will fall back, right? Yeah, short stock guys, ES guys, people who have hedged incorrectly maybe, right? Every month they have to pay the piper, right, with their prime broker. Because the prime broker is like a bookie, okay? They'll give you credit for 30 days. Now, if you're a really good client like Bobby Axelrod in Billions, right, they'll let you go for a couple of months, right? But at the end of the quarter, they got to clean their blotter. Right? And even if you're Bobby Axelrod, right, you're going to have a problem. And people have been just shorting this market in a very stubborn manner. Well, exactly. That's the thing, right? We have a saying in the boiler room, Bean. Buying begets buying, right? So people who see buying, right, they're like, oh, well, hey, the institutions are stepping in. Well, yeah, they're stepping in to cover shorts, but they don't know that. So they start buying. And that just creates that herd mentality. It's shorting those. Well, Apple is a huge part of the index, right? And if you look at the way Apple's been trading, I've been noticing there's something a little kooky with Apple, right? Look at how Apple's been trading. Ever since it broke out of this $400 level, right? It was okay at 3. When this nonsense happened, we had, do you notice this day here? What day of the month is this? Friday the 31st, right? What kind of structure do we have at Apple on Friday the 31st? You guys, this is once you know this stuff, you'll be able to trade with the ghouls, right? And I know this stuff, people are like, why do I know that? Why do you need this? Look at this. Look at how this happened too. They're holding it down, they're holding it down, they're holding it down. They can't hold it down. Okay, you know what? You're getting bought in. At the end of the day, you know what? You're short here. You foolishly added to it here because you don't use market profile. Now the selling shut off here, and rippity doodah, here we are. Guess what? You're getting, you know what? You're short at 388.3. Well, guess what? You got to fill at 420. Thanks for coming. I do a little session on actual market mechanics, um, what goes on in trading, just to kind of give us a little bit. So I thought, we'll have something where we can talk about things like settlement, how to use market profile as a lookout bid, things like breadth and how you can tell if size is in the market, how to sort of interpret ticks, and sort of also the path of order flow a little bit. And settlement is one of those things that nobody ever thinks about. And the reason why it's important to me is because on the other side of the trading equation, the side of the business side of it, settlement is something that we are very um, aware of and get penalized for if certain things don't look right on paper. And it's all accounting, right? And what it is large brokerage firms and the sort of the big money players that play in this market. There are all sorts of different really big money players, but there is a breed of big money players that trade using a lot of credit. Right? So when they settlement and this T+2 you're always hearing me talk about, it's really simple. So the trades that took place today will settle on Wednesday, which is the end of the month. So in a stock, if you had sold 1,000 shares of Apple at 115 bucks, you would be able to pull your $115,000 out of the brokerage account on Wednesday. It means the funds in that account have settled from the transaction of selling your stock, right? So what happens is you sell your stock, the stock goes one way, the cash goes the other way, right? And in the old days, right? Yeah, that's a closing a position, right? It's above HM. Right? So what happens is in the old days, they would actually courier certificates and checks back and forth, right? There'd be something called a securities cage, right? And you'd have couriers who would take stock certificates from one firm to another and pick up checks. Now you can imagine if you have to settle every trade like this, it's pretty nuts, right? So they went to what they did is they went to electronic clearing, right? And there's something called the Depository Trust Company, which acts as the clearing firm for all trades in the United States. Okay. So why that is important in futures trading is because in markets, when markets don't hold settlement, generally you're going to get some sort of margin calls that day. So if I buy a stock at 50 bucks and I'm an institutional guy, right, and I'm doing it for a 3 or 4 day turnaround, right, quick trip. If I buy it and on the day that transaction settles and the stock's 30 or 40, I'm going to have to add margin, right? So that is a problem. And what happens is usually I will sell something that I have in my portfolio that is up so I don't have to add margin or send it a wire. I will always look to see if the market will hold settlement. So this is our close for today. Whoops, hang on. Quick sec. And the close from 2 days ago is down here. So when you look at tomorrow's trading, are we going to hold settlement, which means are we going to stay above this T plus 2 close, which is basically just the close from 2 days ago? And if we can't, are we going to stay in the T plus 2 range? Because say in the market, just out of curiosity, hey, Cartel, just say the market opened tomorrow and we traded down into the 3290s and there was some reason there was a sell-off and we broke this T plus 2 low in that 3220 area. What would happen is the subsequent days we're going to have margin calls because the people who bought in these areas, right, especially on this settlement day, the market didn't hold settlement, so extra money is going to be required. That's why you see when the markets do stuff like this and this, remember when they came off these days here? Here, 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 here. You saw the whole screen was red, right? Gold was down, oil was down, because traders will never, ever, and RX tells you this, traders will never walk into their boss's office and go, we need to send our prime $5 million by the end of the day. Because their boss is going to look at them and go, what did you do, you idiot, right? First of all, you're going to be called an idiot. Second of all, he's going to ridicule you, right? And they don't like to send money out. So what they'll do is they'll sell something that they have that is up or sell something they have that is even to make up that margin. That's why you see markets when they don't hold settlement. Yes, that's from the Big Short. So that's why I look at settlement, because oftentimes this crazy market will come right to the bottom of settlement, flush it, and then move back up higher. It's the craziest thing. Yeah. So unless there's a holiday breaking it up. So today's trades will clear on Wednesday in equities. And because the ES is based on equities, and so is NQ, right? So if NQ or ES isn't holding settlement, there's going to be some margin calls and there's going to be some margin selling. especially if you have a really big down day. And sometimes you will find that we will go and flush settlement. Here's the settle of this day. This day flushed it, or I'm sorry, this was the T plus 2 to this day. Oh no, let's see. Good grief, sorry. Get my head around this. So for example, we have a trading day here and then T plus 1, 2. So you can see that this day and this day, wherever the market was, it held the settlement of this day, the close and also the low, and it closed up. So no margin calls were required on Friday. And those are just sort of little things that you know when you're looking on the other side. I started using T plus 2, the high, the low, and the middle of the T plus 2 range, basically the range 2 days ago, and it started becoming very, very responsive. Sometimes a market will come down right to the T plus 2 low or the close to the tick and then move right off of it. Settlement was something that I manipulated a lot. If I was going to do a short squeeze, I would have, say I had a stock that I had to clean up. What I would do is I would take it down this day and get people short. And then T plus 2 on the month end, I would rip it up higher and then force them to cover into settlement. Here's Friday. Friday's trades will settle on Thursday. And there's the T plus 2 close, that little red arrow. So there's the T plus 2 high, close, middle, and low. Well, usually what they like to do is they like to mark up markets at the end of the quarter and the end of the month, but especially at the end of the quarter. And the reason being because this business model is predicated on people sending money into the market every month. When it's T plus 2 low or close and it hits those to the tick, it's mechanical. No, every reference to me is the same until we go hit it with some order flow, right? So any reference that I look at in trading, I don't put weight on one or the other, right? This is a level for me. If I see it gets front run, okay, then I know what the order flow is at that level, right? If price can come down and it can't get down to my level, that means there's not enough supply to get down to that level. Stray order flow refers, so if you have a margin call, right? So if the market does not hold T plus 2, right? So for example, if it doesn't do that, then you might have what we call a sellout, right? And a sellout is when a clearing firm goes, you know what? You're not going to send the money in. I love you, but I got to sell you out. And they'll go take your position and hit the market with it. So we could be in a trade that looks beautiful. It's perfectly set up. And then all of a sudden, kaboom, we get knocked off our horse, right? That's a stray order. And I like to know when there's a probability of stray order flow. So it means so I don't get my hopes up and I take profits. Find a seller, right? Um, Markets go up, like this market's right now, it's auctioning up, right? You see U period at 33.56. So what it's doing is it's looking for someone to sell, right? When it finds a seller, the market will come down. Now, the mechanics of that, right, and the agenda behind that is when markets are going up, they're usually going up because somebody has bought a position and they're pushing that market higher so they can sell the position. So you with me there? Right? So these guys here, for example, they have a position, right? They're pushing the market up. Everything's going really, really well. All of a sudden, they get to a point, maybe a reference that we've seen before. And all of a sudden, selling comes in, right? Somebody's sitting there waiting to sell. So what a wholesale trader will do is if you see a seller at 57, do you stand there and buy all of their stock at 57? Or do you step in front of him and go sell at 56 and 3/4 and hit out all the lower bids? Because you know that there is size seller, which is supply. And what you want to do is you want to get that supply, right? So you're merrily taking the market up. All of a sudden there's, this guy's sitting here like a big overfed cat, and he's got let's say in this area, maybe he's got 5,000 contracts, right? Okay. No, you'll see the price stall out, right? And then what you'll see is so the people who own a position here are taking it up to sell in this area. This guy's standing in their way. So if they're a seller at 57, what the wholesale market maker will do is he'll come and undercut an offer at 56. And then what that does is it gets this guy to come down to 55. And then what you do is you undercut to 54, right? And see what you do, you make the seller, and then see what this does, it tells you two things. Is it a limit order or is it a bunch of sellers with like market orders? And if you're lucky, it's a bunch of sellers with market orders. So they move down, you move down, right? And then what you do is you have a bid here. Here's your bid. God, these colors are bad. And what you want to do is you keep pushing this seller down, and you keep pushing him into your bid. Right? So now you can buy, you'll hit some bids on the way down too. So what you do is you start shorting and taking out all the bids at 5, 4, 3, 2, and you take out all those bids because you know that you can buy this off of him, fill your short position, go long, and then right now you've got rid of this, get rid of your sell order, right? Now you take this in pro as inventory, and then you take it up and you hold a bid. People will come and buy. You take it up and then you hold the bid. People will come and buy. Take it up, hold the bid. People will come and buy. Because people chase price, right? And then off you go and you're back to work. We bought a bunch of ES or oranges or whatever down here, and we're pushing the market up so we can sell it. And all of a sudden at 57, there's a guy waiting to sell 5,000 contracts. So what we do is we say, you know what? To hell with you. If you're offered at 57, because I see it coming into it as a wholesaler, you're just sitting there. I'm not going to buy it from you there. So I'm just going to step in front of you. This is called stepping ahead of size, right? And what you're trying to do is you're going to try and make him go down here, and then you step ahead of them here. Then they try and go down here, and you step ahead of them here. Whoops, right? And what you're doing is you're pushing, you have your bids down in this area at 51. You're pushing this seller into your bid. So you don't have to pay him 57 or 56. You take him out at 51. And how you do that is you keep moving your offer and hitting the market underneath him, which makes him think that there are no buyers, and they're going to keep coming down, especially if there's market orders. And then boom, you buy it. Then you get rid of your offer, right? And then you start taking the market back up. And what you do is when you take the market back up, you bid underneath it. So that gives people reassurance that they'll come and buy it now at 52, right? Then you slide it up a little bit, and then you put a big bid there, right? Now 53 bid strong. 4, you can sell off the offer, right? Yeah, you can. This is not how you guys are going to trade. I'm just trying to teach you. And let me put a disclaimer. Please, for the love of God, do not try and do this because you're going to get crushed, right? But this is what is going on, and this is what's moving price up and down. Size traders that control these markets are prop traders that have large accounts. Dalton calls them size dynamic traders, right? No, I mean, we talked about this a couple of months ago, and some of our guys went and tried to trade like market makers and got destroyed. So I've got to be very careful. You don't do this because number one, you're going to you're not going to win, right? Because these guys are, they're break trading with a big stack, okay? And so how do we know if that seller is complete? Because it'll go to a reference and stop. And that's usually where these guys have a big bid, right? And if it's a really big order, then it's going to keep coming down and they'll take it all out as much as they can at the cheapest price. Because if this is a desperate seller, right, is there a telltale sign? Yeah, you'll see excess, or you'll see selling coming into a profile. If you just sit and watch, and as soon as you get up to a reference, like here, there was some selling. So they took the market down, bought the seller out here, and then took it back up, right? And when you see, if you're watching the profile and you're watching the replays or with me in the morning, I'll be like, oh, they caught a seller, they're going to take them down to the bid, right? And like that's what you always do. You take the seller to your bid. So this way you guys understand, oh, there's a seller. You know what? Maybe I won't buy while these guys are fighting it out. I'll wait, right? Or take a short until he's complete. When this sell order is gone, right, the market's going to go back up. So I can take a short knowing that the seller's coming in, but I'm going to look at this area to see if they bid them and clean them out. And if they don't, then I can hold my short. If I'm looking to buy, I'm looking for this to kind of finish, and then I'm looking for the bid to push it back up. Exactly. If you can detect it, then you can buy that bid. And it's usually that's why we use structure. Okay. And now I'm going to teach you guys what a lookout bid is. Okay. Because that's what we're using market profile for. And this goes back, and I figured this out because it goes back to my days working markets. And so this is a level 2, very simple level 2 screen, okay, for equities, right? And I'm going to use this to show you, illustrate how market profile works in gathering market intelligence, right? Market intelligence is the most important thing in trading the other side, right? You guys use indicators and charts and all of that sort of thing. Trading in the truest sense of the form is about market intelligence. So this is one of my deals that I did, okay? And I was making this market, right? What I'm doing in this deal is I am pushing the price up so I can sell. So all you people who are DOM traders, right? I'll tell you one thing. Every single one of these bids and offers is me. These are all my guys, and they all have orders from me. And what the object is to make the market look good so you guys come and buy because you guys think you can read a level 2, right? So, ooh, level 2 looks strong. I'm like, ooh, yeah, it's because I made it look strong, right? So I got 100,000 shares bid here at $4.30, right? That's my bid, okay? So I got 400 grand on the bid, and every single one of these are my bids. Is every single one of these bids is mine. This guy at here is a buddy of mine, and I have him up there for 100 and a call. Okay, what that means is he's $4.31 bid. If somebody hits his bid, sells to him, he's going to pick up the phone and he's going to call me and he's going to go, JJ, I'm seeing 100,000 shares from Knight. No, it's my market. My clients own all the stock. The hell are they going to do? They tap me, they're short at 4:30. Tomorrow I'll open the stock at 6 bid and buy them in. Come and tap me. I dare you. I'll buy you in so fast it'll make your head spin, right? It all depends on the deal. It all depends on who's running it, right? Of course, you're going to have people backdooring stocks sometimes, but so that's why you have a lookout bid, right? So if my buddy Sean calls me and he goes, hey, JJ, I'm seeing 100,000 shares from Knight on the bid at 431. Well, then I know I got a leak in the boat, right? But if he sees I'm seeing 2,500 from Canaccord, buy it and stay, right? So that bid is telling me what the order flow is that's coming into the market so I can adjust my strategy. Market profile does the exact same thing by using these structural points as our lookout bid because this is a huge market. It's a worldwide market. I can't have a buddy up on the bid and call me and tell me who hit me, right? So that's what I'm doing. I'm using market intelligence, using the structure of the profile to tell me, oh, we came down to 34.54 and a quarter, right? And we bounced. So that means the seller is not that big. So if I was wanting to go long, I could go long there because I see that there's a responsive buy there, right? Because there isn't 30,000 contracts coming to that line. If there were, it would break down all the way down. So that's what the whole, you always got to remember what we're doing is we're trying to build demand, right? So what I'm trying to do, and this is a deal I was working on, where like this is my chart. So I don't know how to read charts, but I can build them, right? So I built this thing up. We opened it just under a buck, right? Put the paper in. We opened it up, right? You let it trade a little bit of volume here, right? You wet everybody's beak, that you owe favors to under a buck. And then you start tick, 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 tick. You get the boiler room going. You get the retail orders coming in, right? And you're building demand, you're building demand, you're building demand. Then you get this nice big move. And I never knew that, what kind of candle this was or anything like that. But I would I'd give it I'd goose it a little bit because I know you guys like this big green thing, right? I don't know what the hell it was, but you would come, right? This is like a party invitation, right? Yeah, we never use those. No, that's I saw that. It's really cute, but no, we never use that stuff, right? But so we like to do this to make you guys go, ooh, that just gets people excited. I don't know, right? That big thing, that really, I don't know what you guys call that thing in candle wax therapy, but it gets everyone excited, right? Because we did 7.6 million bucks that day, and a good time was had by all. Now, the next day, now that I've got you all at the party, I got to feed you, right? Because the ducks are quacking, and now you feed them. And so I hammer the market, right? And a lot of people have good till canceled, limit orders. They're all sitting there trying to buy bounces, right? And then that's when I hammer the stock. And this is what we call distribution, right? And that way, you know, out of this $10.2 million worth of dollar volume, I should be at least a good 7 to 8 million bucks of that, right? If I'm not, I'm fired because my clients own all the stock. So we should be at least 70% of the volume, right? So that's what I used to do for a living. I'd bring you to the party and then I'd get you drunk. That is that is a lookout bid, and that's why I like market profile because it's telling me right now that we have 3 ticks of excess, but we're having a hell of a time getting to my level here. So if my market maker um, Sean was there, or if Shaky or one of the guys was there, he'd be like, "Oh, there's nothing here," so we'd slide up. We'd slide the bids up so we could sell what we bought here, up here. Uh, when Zoom skyrocketed after earnings, it wasn't the market makers. The market makers are short to you because they have to sell you stuff. So if say we didn't have any market makers in the market, right, and you guys could just your order would go and get matched with Andy's, what would happen is if you went to buy, for example, a stock and it was 5 bid, 505 offered. Well, Andy's only got 100 shares at 505 and you're trying to buy 1,000. So you go to buy stock at 505, you get 100 shares. And then what's the next offer? 510. And what's after that? 520. So by the time you ended up accumulating your 1,000 shares, you might have a cost basis of $5.60 on it because there's nobody willing to sell you stock where you want. So that's what the market maker does. They sell you stock at a price that you're willing to pay, right? And they're doing that to provide liquidity to the market. For this, they get paid a lot of money. Also, because of this, they are at huge risk because they are the ones who get stuck holding the bag, sometimes for days and weeks on certain stocks, right? If you talk to somebody like Paul Asmar, who was a specialist at SLKC, these guys will go down. They'll go home down 5 million, 10 million for the day because you have to buy. It's a responsibility. You've paid the brokerage firm for that order flow. So, you have to stand in there and fill their orders. Right now, you're not going to pay them what they want, of course, but you still have to take risk. A specialist is just like a market maker, but usually specialists in the old days, right, there'd be like one specialist for one stock. And usually it was like a generational thing. Like the Ford specialist, his grandfather, his father, like it's the way it was. Like they had these very big firms like LeBranch, Bear Wagner, SLKC, you know, these very, very sort of. I remember the very first specialized I met 1995. I'm in New York for a Discovery Expo, right? And we're at our booth. This guy walks up and he's wearing like this camel hair coat. The coat must have been like a $10,000 coat, right? You know, Brioni suit. You know, he's like everything that he was wearing was worth more than both of our cars put together. So my buddy goes to him, "Hey, so what do you do?" He goes, "I'm a specialist, New York Stock Exchange, right? Bear Wagner or something like that." And my buddy goes, "Oh, so what do you have to do to become a specialist?" The guy looks at him and he goes, "If you have to ask, you'll never know. My assistant makes 7 figures a year." And he turned and walked away. They used to be pretty highfalutin. And then, you know, electronics and all that came, and you know, the floor of the exchange is now fairly just for show, as Paul would say, right? So a specialist makes markets in listed securities, New York Stock Exchange. A market maker will make markets in unlisted stuff like or over the counter, right? Short covering means, so say you short, so team, say there's a stock and you sell 1,000 shares at $10 and you short it, which means you don't own the stock. You go and borrow the stock, you sell it at $10, the stock drops to 8, you cover, which means you buy it back at 8, take the $2 win, and replace the stock with the guy that you borrowed it from. Okay, a P-shaped profile occurs, right, when there is a short. The market comes down, and when it comes down, in C period of this day, it establishes excess, right? The market moved up, sold off, and what happened was the price went down all the way to this 1540 area, and it rejected back up because there was nobody willing to sell down here. With me so far? The next day, you'll see this weird P-shaped profile. And the reason is people who are short in this area have not gotten a cover yet. And this profile, the excess of this profile does not get into or challenge the excess of the previous day. So this excess means that the auction to the downside, this means basically the selling's over. The sell order is completed. The next day you can't get down there. So when the market opens and drives higher, there are people who are short position-wise down here. And what they're doing is they're trying to cover, but then retail gets FOMO and chases and pushes price up. So remember in our example we had the seller, right? Well, what happens is we have sellers in the market here and here, right, in that day, and the price goes all the way down here. Now, when the price gets down here, there's probably not a lot of volume, or they'll print a block, right? And what'll happen is they'll take the price back up, and people get caught short in this area. So there is a short position. I'm going to put that here in red because they've sold what they don't own, and they're short here. Right? It's not all smart money. It's fast money. There's a difference. Smart money are the people who buy and hold for 30 years, right? But there's a lot of fast money traders who get caught chasing price down in the hole. So here's the short position, right? The next day, what happens is the market opens up here, comes down into this area. When it comes down, FOMO buyers and other buyers step in and bid the thing. So if you have a bid in a market and a short position, right, the retail and momentum traders will come and push price up and the shorts will cover or try and cover, right? And they'll creep their bids up to a certain point and they'll sit there and they'll wait. Exactly, right? And as the market trades through the day, the bids take it up and the shorts are stuck. And what happens are there are bids here. Yeah, sorry. So there'll be bids here, bids here, bids here above the short position. And that's causing this P formation because every time price gets down here, it gets absorbed by buyers, right? So you still have a short position underneath here, but what's going on is every time the price comes close to where the shorts can cover, somebody steps in and steps ahead and buys. The next day you get what we call a B profile with no excess at all, and the selling has completely cut off right here. And you'll see the selling has cut off right where value area high is of this day. And this is, you know, for all intents and purposes, if you see some of these stacking up, then the market's going to go higher. In this environment we have now, the hardest thing for people to imagine is the amount of money that's sloshing around. You know, when you have a lot of people who are trading with 50, $100 million, right? It seems like a lot of money, and it is, but there are a lot of them, and not all of them were winning. If it broke into the previous day's value, not a big thing. What you want to do is you want to be looking for if it breaks that tail and comes into this one. That means your selling is serious. When a market maker is short, it's called being, well, no. It's providing liquidity, right? It's called being short to retail. Julio comes to me to buy 1,000 shares of Microsoft. I don't have any in the back room, but guess what? I'm going to sell you 1,000 shares anyway. Now I am short to you who is retail. Then I will try and go on the bid and hopefully somebody hits me. I sell to you at the offer and I buy it back on the bid. And for that 1,000 shares, I make the spread. What changed? Actually, retail was non-existent until this last year. Right? We didn't have any retail in this market at all. Right? They killed retail after the internet.com bubble. They killed retail trading because they made equity traders have what that stupid pattern day trading rule, where you have to have $25,000 to execute more than 3 trades in one day on the same stock. Why is that a rule? Because people sat down in front of their computers like a slot machine, and they were just buying and selling and buying and selling and selling and buying, and they didn't know what the hell was going on. It's a week, right? Not a day, yeah. Right? And people blew up. We basically, I mean, pattern day trading rule paid for a lot of my friends' boats, planes, and then they got that PDT in, and as soon as they got PDT, and then in 2005 with regulation SHO, they took the retail short out after they took the retail long out, and ruined the industry. Now what has happened is the large companies like BlackRock, Fidelity, they have so much stock, they don't have anybody to sell it to. So let's make retail traders come back into the market, give them Robinhood, give them zero commissions, give them fractional share opener. You can see what's going on. always remember, markets are made. They don't just spontaneously occur, right? Markets are made to sell you something, right? Always remember that. Well, it's actually not, it's worse than that because what I did once is I had a group of young guys that I trained, and I taught them I taught them how to, you know, how to run deals and how to make markets, and they went and oh god, they were like a virus that went through the junior markets and basically just raped billions. And unfortunately, I created that, so I got a lot of redeeming to do. I mean, most people don't even know that when they buy stock, they don't really own it, right? You know, when you're in the US and you buy stock, you don't own the stock you buy. It's owned by DTC and Seed and Company.